Good afternoon, everybody. I think it's 3 p.m. in London, so it's the time when you're all joining us for our first webinar on the Katch Litigation Fund. Thank you very much for attending, everybody. For those who don't know me, I am Laurent Jeanmart. I'm one of the founding partners at Katch. Katch, very quickly, is an asset management company dedicated to liquid private debt. We've got $850 million of assets under management, of which about 300 million is managed through funds, a fund umbrella based in Luxembourg, which is called Katch Fund Solutions. As I said, it's the first time we're doing a webinar on our litigation fund, so we're quite excited about that and explaining to you in details what we do, what we're trying to achieve, what have been the results so far, and perhaps how we're different from other litigation funds you might have come across. Please don't hesitate to ask questions. As always, we're here to answer those. Sometimes, when you are too much into it, you brush over things that seems obvious to the speaker, but not necessarily to those who listen to it. So please feel free to ask questions. We're going to carve out some time at the end of this presentation to answer those questions. Together with me today, I've got Leon Clarance. Leon is head of litigation funding. He's going to talk to you a bit later on about, what is in the portfolio, giving you some concrete examples of what we are funding here. What is the outlook for the portfolio, for the market itself. But before that, I'd like to spend a little bit of time on explaining why we think litigation funding is just a fantastic asset class. So that's the first thing that I'm going to talk briefly about. Then I'm going to go over the team. I think it's important for everybody to understand who is managing the portfolio. Here at Katch, we've got specific, I think, expertise in various aspects of the offering. So, I'm gonna tell you briefly who's participating in the management of this product. Then perhaps I'd like to spend some time on why Katch, basically. Why are we different? What are we doing differently? Why we think our product is perhaps more attractive than other funds in the space. So I'll jump right in. First, when people ask me why is litigation funding attractive, I always say, look, it's from a very high level. This is very simple maths. If you look at a very large number of claims in the UK, you can see that almost exactly 50% of the claims or cases that are judged are being ruled in favor of the claimant, and 50% are being ruled in favor of the defendant. So it's a well-balanced system that we've got here in the UK, which is a good starting point. Now, a litigation funder is an investor who essentially tries to extract, obviously, value or capital or performance from his investment. And the classic terms under which this is done is the following. If we win, we typically get 4 times the amount that we invested. If we lose, we lose about, we lose the entirety of our investment, which is, by definition, 1 time our investment. So if you've got a diversified portfolio of cases, quite quickly you can see that, if you have a 50% win, so doing exactly the same as what you would have done, picking random cases in the UK market, you would double your money, basically, because there is a skew. When you win much more than when you lose. So that's a very good starting point. And because we think that the average duration for claims in the UK is around 3 years, if you do just a very simple back of the envelope calculation, you can see that the internal rate of return, just doing this, is in excess of 25% per annum. Now, there's not many asset classes that can return 25% per annum just by virtue of being in the market. Of course, we're trying to do things that are a bit better. We're trying to do shorter claims, as a lot of you know already. We're trying to basically to select cases that have better than 50-50 chance of winning, but it's a very, very good starting point. And of course, we're all trying to build, for our personal benefit or for the benefit of the clients, portfolios with uncorrelated asset classes. Litigation funding is truly, qualitatively and quantitatively something that's different, that's bringing you a different stream of performance of alpha in your portfolio. So that's basically my introduction. I'd like to spend a bit of time on the team. You're going to see the team here on our presentation. As I said, Leon Clarance, who is with us today, is our head of litigation funding. Leon has a wealth of experience in the small claims market, perhaps with a particular focus on tax schemes, which have been in the past all the rage and which has created a massive amount of liabilities in the market. Leon went to Cambridge and Harvard for his education, so a very bright individual. Thank you, Leon, for being with us today and adding so much value to this portfolio. We've got Anais Kabir, who is basically our lawyer, helping really Leon with the structuring, with the analysis, with the implementation, and the ongoing monitoring of the claims, which is a very important task. Anais is ex-White & Case. She's got a master's degree in law from Panthéon-Assas, a very prestigious university in Paris. She's a New York State attorney at law as well. A lot of what we do has a structuring aspect to it, and so that's something where we do get the support of Maria Ryan. Maria is a senior credit officer with in excess of 20 years of experience with various outfits. She's also she read at Cambridge University as well. She's a CFA charter holder, so also a deep kind of background here. Everything that we do at Katch has to go through an investment committee, and the three partners at Katch are essentially members of this investment committee, and we discuss every single trade that goes through the portfolio, including those going through our litigation funding fund. And finally, he's not listed here, but we've got our portfolio manager, Fernando Pinedo, who is basically in charge of implementing the trades and making sure that everything is hedged properly and all these things. So we've got a reasonably deep bench for funds that is reasonably young. I mean, performing well, yes, and growing fast, but we definitely have the team to cover all bases. Of course, when we do invest in litigation assets, we often require the help of external counsel. So it's not listed here, but it's kind of reasonably obvious. So without further ado, I'm gonna jump now on why Katch, because at the end of the day, it's one of the key message that I want to deliver today. Why we think that we're doing something differently and perhaps more attractive than the rest of the competition. First, our fund is organized as an open-ended fund, which is quite a rarity in this space. Most of the exposure you can get in litigation funding is being acquired through closed-end funds. So in other words, you have to commit for 5-10 years, maybe sometimes, to get exposure to this very performing asset class, attractive asset class, but very illiquid asset class. And we have the liquidity to offer. We have enough liquidity in the portfolio to offer effectively 6 monthly liquidity, which is very liquid a fund of that nature. And we do this because we have enough liquidity in the portfolio. You know, as a background, I was previously the CIO of an insurance company, so asset liability matching is something that's quite dear to my heart. And I make sure that we have enough liquidity in the portfolio to serve our investors and serve basically our commitments as well in the fund. We focus on short-term opportunities in litigation funding. I think, you know, when people think about litigation funding, they think about sort of complicated commercial cases. It's not really the case here for us. We're focusing on, honestly, claims that are much more simple, where the legal merits are much more clear maybe than in larger cases, where we have perhaps the benefit of a large number of claims having gone through a court proceedings, which gives us objective measures as to what sort of probability of winning we can achieve by funding those claims. And finally, you know, these claims being much smaller than the average claim in the UK, it gives us very quickly a very high level of diversification. Today in the funds we have in excess of 2,500 claims, which is you know, perhaps much more than what most people expect. And we think that this is going to grow further, maybe to we hope around 4,000 by the end of the year. More, you know, those claims have an average duration of 11 months on average, which means that, again, you know, the portfolio is more liquid. You know, turnaround time is much faster. The flip side of that is we think the capacity for the strategy is less, but we're not trying to build an empire here. We're just trying to make good money for our investors. The fund is organized as a tranche fund, which is a slightly unusual structure, perhaps. But that means that effectively we at Katch are exposed through investments in the equity tranche of the fund, which means that, you know, if there are losses, we take the first losses. And we offer to our external investors who fund us a minimum net return of 8% per annum, plus an additional 8% depending on realized income. So, you know, as an external investor, what we're offering is exposure to a totally uncorrelated asset class, yielding between 8 and 16% net per annum with 6 months in liquidity. I think, you know, it's a very strong offering when people try to get exposure to, or try to get some yield and get exposure to a different asset class. The pricing of the portfolio is independent. We have hired an accounting firm, which is a specialized chartered accountants based in the UK. They call Hainsworth Chartered Accountants. It's a mid-sized firm, but highly specialized in pricing, amongst other things, how to value assets. They have the mandate to do that every month independently. It's a firm that has about 30 offices, 1,000 employees. So it's a reasonably strong and well-established outfit. They report directly to the administrator in the pricing of the fund every month. One of the main aspects of investing in the fund, if you are a seed investor, an external investor, is that you should be concerned about two things really when it comes to the fund. The first one being the level of subordination in the fund, how much equity is there to protect your downside. And I think that at the moment is well in excess of 30%. So in other words, the portfolio has to go down by 30% before external investors would be impacted, which is substantial. And the second element that drives your returns is obviously the amount of realized income. That has been substantial since January or February of this year. We've seen, you know, very good levels of realized income, and that's why the realized return over the last 6-8 months has been very close to 16% per annum. So I've been speaking a lot, and I'm looking at my friend Leon I think he's dying to let you know a little bit what's in the portfolio. So without further ado, I will hand him the baton and let him explain, in perhaps more details and in a more interesting fashion, what you can expect to see in the portfolio at the moment. Leon, the mic is yours.
Thanks, Laurent, and nice to see everyone on the attendee list. There's quite a few of you who are familiar names to me based on queries that I've been processing over the past few months. So it's lovely to see some more interested attendees turning up. I'm sure you'll have some more interesting questions for me going forward. As Laurent mentioned, what he's asked me to run through today is a brief overview of the constitution of the portfolio, both in terms of where it is now and also, more importantly, where we'd like to go, and then to give you a little bit of an idea as to the performance of the fund so far. Currently, we have effectively 5 positions within the fund. These are all discrete pieces of litigation based on very, very different points of law, which provide, as a result, perfectly uncorrelated performance across them and between each other. Those claims effectively run the gamut, really. One is at one end a very, very large group claim against a high street bank. And at the other end, we have some very, very small claims that go through the Financial Ombudsman Service, where individuals are effectively seeking redress effectively outside of the court system, which is unusual. There's effectively a separate body that governs financial products in the UK, which allows for a much simpler process for litigants in person. Laurent's just kind of clicking through a couple of slides there on FOS. In essence, the Financial Ombudsman is a government-backed scheme which effectively acts as an arbiter of sort of last resort, effectively, for individuals who may have been sold a financial product, an investment, a loan, anything that's governed by the Financial Conduct Authority itself. Individuals can actually approach the Financial Ombudsman themselves, but sort of what we've done is we've worked with a regulated claims management company, and that regulated claims management company has provided some very, very powerful book building support, where they've effectively built a book of claimants with very, very similar claims in respect of one particular point of law. This one in particular was in respect of pensions, cash liberation. In the UK, it's very onerous if you try to take your savings out of your pension before your allotted time, either the early retirement age of 55 or the later age of 67. Following the financial crisis, a lot of promoters tried to develop very, very exotic schemes that allowed people to try to access their pensions. Invariably, they failed. Worst case scenario is they fail and you get a tax bill. But sort of in this particular circumstance, it was even worse in that the underlying investments themselves effectively proved to be non-existent. So not only did they lose their pension money, they were cobbled with a very, very large and unpleasant tax bill. Understandably, there's a case for redress via the Financial Ombudsman Service as a result. Turning to some of the other types of claims that we've done, we refer to them internally as wholesaling claims, but what we're effectively doing is providing a disbursement facility, funding facility to particular law firms. In essence, a lot of law firms, again, work on very, very low value but high volume claims on a no-win, no-fee basis. But one aspect of the cost of litigation is that there are typically certain disbursements that are required to progress a case, whether that's court fees, hearing fees, including having a barrister or a solicitor with rights of audience attend, and oftentimes you need expert witness analysis as well, or indeed case acquisition costs. Law firms effectively seek external funding for these. What they're effectively doing by borrowing that money is buying turnover, because they're effectively buying the cash that unlocks their ability to progress these cases. We have two different pockets of cases sort of within this wholesaling sort of type, if you like. One that's on the slide there relates to cavity wall insulation, which I won't go into too much detail on because it's something we've covered quite a lot in terms of our updates. But in essence, it relates to 40 insulation work where the underlying damage to the home has become quite significant. The one that's more recent, however, is the Plevin case. Many of you who are familiar with the UK landscape will be aware that there was a lot of claims against financial institutions in respect of PPI, which was effectively payment insurance, where individuals took out borrowing and effectively that borrowing was sort of sold to them with an insurance product. Invariably, those insurance products were simply inappropriate for the borrower. There was a huge regime to liberate redress from the PPI system, and an evolution of that has come in that there's a particular case, a lady by the name of Mrs. Plevin, who litigated against her lender because the lender recommended an insurance product, but the cost of that insurance product, over 60% of the payments she made were actually commissions that went to the lender. So that was a form of an undisclosed commission. Undisclosed commissions are effectively have been approved to be unlawful. And what that has done is effectively open up the marketplace again for anybody who had any kind of borrowing where they took out a repayment protection plan to see if they can possibly recoup those costs where those commissions were undisclosed. What we've done there, as I mentioned, is effectively provide a funding facility to a law firm. A lot of litigation funding is effectively done on the basis that a litigation funder will fund a case and there will be a binary outcome, which Laurent has mentioned. What we've done with the litigation funding sort of opportunity here is we've effectively lent the money to the law firm, taking a fixed and floating charge on the balance sheet of that law firm. The headline terms of that facility included a 20% per annum coupon, plus a share of the damages that were payable to the law firm for each individual case. The rationale behind taking an interest coupon and a share of damages, notably a much smaller share of damages than we would have typically taken where we were just purely funding a case, is that we've effectively obviated any risk or delay risk in litigation. Oftentimes funders for litigation find themselves funding cases that are purported to last 3 years, but end up lasting 5, 6, 7 years. And what that does is obviously create an incredible drag on returns. By lending directly to the law firm, we're clearly incentivizing the law firm to progress cases very, very promptly, but we're also avoiding any delay risk. That's been very, very important as a concept, as you can probably imagine, following the COVID epidemic, because what that's effectively done has led to delays in the court process. For example, just jumping back to cavity wall, one of the things you need is a surveyor to go and access houses. During lockdown, it was just not possible. So some funders found themselves having commenced litigation, but they couldn't progress matters because they weren't able to physically access houses going forwards. Moving on to the returns then, as I mentioned, we're also taking a share of the damages from the cases that are funded. The real trick really for Plevin cases is that hopefully they will progress promptly, allowing the law firm to recycle the money quite promptly. As a result of that, whilst we're taking a much smaller share of returns, it's highly likely that the share of damages will probably treble the return that we would otherwise take merely from the interest coupon itself. That's quite interesting as a prospect, because what we've effectively done is structured the facility in a way which clearly services our investors' needs, but then also provides potential for growth, effectively partnering with the law firm in their success rather than, say, for having a disproportionate level of return from the litigation proceeds at the end of the case itself. Laurent mentioned that the returns as a result have looked quite attractive. During the initial phase from launch through to February 21, we were effectively building out our fundraising capability. And then obviously we started to deploy capital into a variety of cases at once. We started with a book of cases of around about 250 claims. And as Laurent mentioned, we now have several thousand claims that have been funded. The net asset value growth of the fund has consistently been at 1.1% per month growth or higher since my joining, really. There's no real coincidence there. It's merely a function of the fact that a lot of the deals effectively came online just as I also came on board, which was great. It was also great to be able to see the work that had been done prior to my joining from the team. Laurent mentioned the entire team, and I think we very much do kind of work as a pack, albeit we are internationally disparate, but it's great working with a multicultural, diverse team across these projects, because everybody brings a different insight and level of experience to the types of deals that we're doing. As a result of what we've done in terms of trying to lock in return, our performance is typically hovering around about 16% per annum currently. And a real focus has been put forward to diversifying the portfolio in terms of the number of claims that we're effectively progressing. In essence, what we're doing is we're trying to focus on very, very discrete pieces of litigation that have affected a very, very large number of people. What that enables us to do is to identify a piece of law where we can really see that litigation is going to make a difference, and then work with book builders, whether that be brokers, aggregators, or law firms, to identify target markets where the impact of litigation funding is going to make a real difference to people. People often talk about litigation funding providing access to justice, and I think that's very, very clear from what we do, where we're effectively helping people enter litigation who would typically not be able to afford the costs of litigation itself. So we have 5 sort of pods, if you like, currently. We're looking to get that up to somewhere between 10 and 15 pods over the course of the next year. We have a capacity assessment of something like £150 million sterling, and clearly a lot of focus and effort and due diligence is currently spent looking at new opportunities where we can effectively get very, very detailed analyses of both the point of litigation in hand, the lawyers that we're working with, and also understanding the marketplace. Can we really build a book here? Indeed, Lauren and I were talking just last night about an opportunity where the base case opportunity has a target market of something like 100. Of that 120,000, we think there's probably 40,000 people for whom this particular piece of litigation is relevant and where they have a bona fide claim. So as you can see, a very, very small piece of litigation with wide applicability provides a significant opportunity to deploy capital in a relatively secure way. By providing law firms with funding facilities and taking security against their income generally, we're obviously protecting our downside whilst allowing them to share a little bit more of the upside than we might otherwise do on a sort of binary funding proposition. In terms of where we are in the fund's life cycle, as Laurent mentioned, we're relatively new, but we're already seeing cases progressing to litigation, having done quite extensive book building, and we're imagining that over the next year or so, we'll start to see some quite significant growth in the opportunities that are presenting themselves to us. A lot of the larger litigation funds are literally too big to look at these types of claims. My experience of dealing with other litigation funders, they'll very happily say things like, "Well, I won't get out of bed unless it's a £10 million litigation budget." From our point of view, that's all very well and good, and there's clearly a market for that type of litigation. But I think our focus on very, very small value, high volume claims where we can deploy capital very, very securely is very likely to lead to us having a very, very distinctive proposition in the marketplace from a legal point of view. And clearly, Laurent has already explained that the investor proposition is quite distinct here as well, providing hopefully a very, very nice combination and matching of inflows and outflows. As Laurent said, he likes to spend his spare time and hobby activity matching assets and liabilities. Laurent, how's that?
Yes, thank you, Leon. Yes, I do. Thank you very much. I'm just conscious of the time. I mean, the problem with this asset class and essentially, everything we do at Katch is that we can, if you get us started, we can talk about it for a very long time. So I think we have a couple of minutes left for this webinar. I've received quite a few questions. I think one of them I would like to address with you, and that's the following. Is the fund ESG compliant? It's a difficult one because it's not a traditional fund that would be eligible to that sort of framework. However, as Leon mentioned, there is definitely a social aspect to it in the sense that we are bringing justice to people who wouldn't otherwise have access to it. So we are looking very closely into doing it. This is a project that Anna is leading. We are looking to make the fund ESG compliant in the very short term. I think sort of it matches what we're trying to achieve above and beyond, making good money for our investors. It's also quite important that, we're doing something good as well for society as a whole. I think I have 1 minute left. I'm just gonna, before thanking you all for joining us, I will just mention something about capacity. Yes, we think we have about 150 million pounds of capacity. It's a bit of a moving target. You know, at the end of the day, this is a market that could be much, much bigger than what we think we can manage. But we want to be conservative here. We want to be careful. And we essentially, you know, reassess our views when you know, we deploy capital or when we see other opportunities. An opportunity like Plevin or an opportunity like Cavity Wall are opportunities where you could deploy tens of millions if you wanted. But you know, we want to achieve a diversified portfolio. It's a diversification game for us. And sort of that constrains a little bit how much money we can manage, which is fine by us. We have no intention to be running, you know, an empire. In contrast with some of our competitors, what we want to do is we deliver consistent and correlated returns to you effectively. On this, I'm going to thank you everybody for attending. I think we've got a very high number of participants, which I'm very happy about. Feel free to please reach out to any of us for any question you might have, and would be very happy as well to get into the details of this offering on a face-to-face basis now that the COVID crisis has allowed us to travel a bit more and meet all of you guys a bit more frequently. Thanks again. Have a good afternoon, and stay tuned, because next month we're going to be coming with another of our offering on our next webinar. Thank you again. Bye for now.